Read that again. You borrowed $250, you paid back $576. The extra $326,000? That's interest. That's the price of admission. First decade, almost entirely interest. You're paying for the privilege of living somewhere, not building equity, not building wealth, not building anything except the bank's portfolio. Credit cards? Worse, 18 to 25% interest, sometimes higher. Auto loans drain you monthly. Student loans follow you for decades, $100 in interest accumulating while you barely touch the principal. But here's the real knife, the twist that makes this whole thing brutal. You pay those loan payments with after-tax income. Listen to this carefully. Your mortgage payment is $19,200 a year. You need to earn $29,500 before taxes if you're in the 35% bracket just to cover it. Think about what that means. You're paying income tax on money you earned. Then you're paying interest to the bank on the same money. Income tax, interest, simultaneously, back to back. This double squeeze, this double extraction, this is why people never escape, never get ahead. They take out loans with after-tax money that's already been taxed once, pay the bank interest on money they never fully control, money that's already diminished. Meanwhile, the bank, zero risk. They've collateralized your asset, your house, your car, your business, whatever you borrowed against. Miss enough payments, they take it back, foreclose, repossess, resell it, probably more than you owed. You don't own your home, not really. The bank does. You're renting it from them at a premium until the final payment clears, decades later, when you're old. This is extraction. This is how the system extracts value from the working class, the middle class, anyone who doesn't understand how the game is actually played. Why does this happen? Because you're high risk. Asset risk. The bank doesn't care how much you earn, not really. It cares how safe your money is, how predictable, how secure. Make $150,000 a year? Sounds good, sounds impressive. But no savings, no collateral, volatile job, tech startup that might fold, gig economy work?
Red flag. Walking liability. Danger zone. You might feel middle class. You might think you've made it. To the bank, you're one bad quarter from missing payments, one layoff from default, one medical emergency from bankruptcy. They check your credit score, debt to income ratio, employment history, length of employment, stability of your industry, everything that signals whether you'll make payments reliably for the next 30 years. Someone making $40,000 with a paid-off house? More bankable than someone earning $200,000 drowning in credit card debt. Because the $40,000 person has assets, has stability, has proof they can live within their means. The $200,000 person? Liabilities, risk, questions. Consumer loans have high interest rates because you're paying for the perceived risk of lending to you. The bank is betting you might fail, pricing that possibility into every payment. Now, finally, we get to the real game. The game that nobody tells you about until you're already in it or already rich enough that it doesn't matter.
For more success content, earning opportunities, and endless giveaways, be sure to visit wealthhealthself.com.